Picture this. It's early 2025. You wake up, check your accounts, and for the first time, something feels off. Not because of a market crash, not because of a recession headline, but because something deeper is happening. Something ancient. A pattern. A pattern that wiped out Rome in 33 AD, that gutted France in 1789, that obliterated Weimar savings in 1923, that forced Europe into a debt cancellation in 1953. 5 collapses, 5 different eras, 5 different triggers. One identical ending. The debt wasn't repaid, it was erased, and the people who got erased with it were the savers, the responsible ones, the middle class. Now that same pattern has returned, and it's sitting right inside 2025. Global debt has hit $300 trillion or 335% of world GDP. The global economy creates about 2.7 trillion in new value each year. But the debt demands over 9 trillion in interest. That's not economics, that's math. And math doesn't negotiate. This is why inflation 2025 feels different, because it is different. This isn't a normal cycle, it's stage 3 of a debt pattern that has never once ended without a reset. And if you think that sounds dramatic, give me 10 minutes. You'll see why this time is not an exception, it's a continuation. Every collapse begins the same way. Not with a war or a riot, but with cheap credit. Rome did it with land loans, France did it with royal debt, Weimar did it with reconstruction spending. The US did it from 1980 to 2008, credit cards, student loans, mortgages, 0% rates. People feel richer. But all they've done is borrow the future. Then stage 2 hits, debt passes 250% of GDP. Every empire, every nation, every economy that crosses this line eventually faces the same outcome. It happened globally in 2010. Instead of pulling back, the world doubled down, 250%, 280%, 300%, 335%. Stage 3 is where the trap snaps shut. When interest grows faster than the economy itself, the system suffocates. You produce $1. That dollar goes straight to interest. To pay that interest, you borrow more. Borrowing more raises the future interest bill. Round and round until the structure cracks. Rome confiscated land, France printed assignats, Weimar printed money until a loaf of bread cost billions. Europe in 1953 had to wipe out half of Germany's debt just to breathe again. And now look at the United States. Federal debt, 36 trillion annual interest. Almost $1 trillion if rates normalize, that interest jumps toward $1.5 trillion. GDP grows by maybe $600 to $700 billion a year. Interest eats all of it, and more. This is what historians call the recognition point. The moment when anyone with a calculator realizes the debt will never be paid. Not in real terms, and once a society hits that point, the next phases follow like clockwork. Political pressure, social anger, financial fractures, then the final stage. Reset. Not reform, not repayment. Reset. Through one or a combination of only 3 methods. Inflation, debt cancellation, war. It has never ended any other way. So, here's the question you have to confront. If stage 3 arrived in 2020, and every previous cycle reached stage 6 within 3 to 7 years, then where does that put us? 2023, 2027, which means the window isn't theoretical, it's now. And if you still believe this is just another normal economic cycle, the next part will break that belief completely. Because in every reset of the last 100 years, only 3 positions kept ordinary people from being wiped out. And you're about to see why. Here's the part that most people never see until it's too late. In every reset, whether it was Rome, France, Weimar, or post-war Europe, the same 3 characters always stepped onto the stage. The saver, the debtor, the hard asset holder. And the ending was always the same. The saver, the person who trusted the system, held cash, collected bonds, lived responsibly, was the one who got wiped out first. Every single time. Their cash evaporated, their bonds defaulted or were paid back in destroyed currency. Their savings, decades of work, were erased in a matter of months. Then there was the debtor, the person who owed money. In every reset, their debts shrank or disappeared in real terms. Inflation did the heavy lifting, the reset did the rest. And finally, the hard asset holder, the person who owned land, gold, productive assets, or shares of real businesses, they didn't just survive, they often came out wealthier after the chaos than before it. In France, 1789. Landowners with mortgages watched their debts melt away as the assignat collapsed. Weimar 1923. People with property or commodities saw their wealth explode in nominal terms while everyone else drowned. Europe 1953. Half of Germany's public and private debt was wiped clean overnight. Anyone holding real assets? They walked away standing. If you look closely, the pattern isn't about luck. It's about positioning. Savers get sacrificed, debtors get relief, hard asset holders get leverage, and the middle class keeps making the same mistake, standing in the exact place the pattern hits hardest. Most Americans still believe the safest place in a crisis is cash, bonds, and stable income. But in every major reset, those were the most dangerous places to be. Because resets don't punish the reckless, resets punish the unprepared. Once you understand that, you stop asking, will there be a reset? And you start asking, which role am I playing when it hits? That's where the real shock hits. Because most Americans, without realizing it, are playing the role of the saver. The one history has erased 5 times in a row. And nothing traps people in that role more effectively than the single, most widespread piece of financial advice of the last 40 years, the 60-40 portfolio. The advice that said, put 60% in stocks, 40% in bonds. Bonds are safe, they protect you. That advice worked in a world where debt was manageable, inflation was tame, and interest rates were falling for 40 straight years. But that world ended in 2020. Today, 40% bonds doesn't protect you, it exposes you. Because holding long-duration bonds in a high-debt, rising inflation world isn't safety. It is volunteering to be the creditor in a system openly moving toward debt cancellation and controlled inflation. And the worst part, millions of Americans don't even know they're doing it. Their 401k target date funds are stuffed with long bonds. Their retirement portfolios are built on assumptions from the 1990s. Their financial advisors still talk as if debt is manageable, even though the interest bill alone is crushing the system. If your 401k is holding long-term bonds right now, you're not conservative. You're the exact person this pattern was designed to erase. Because in a debt reset, creditors don't get rescued, they get sacrificed. And if that sounds harsh, good. Because the truth is harsh, and sugarcoating it won't save anyone. Here's the part most people never learn until it's too late. When a debt system reaches its breaking point, the safest place is never bonds. Never cash, never fixed income. The safest place is always the same 3 positions, the same 3 that survived every reset since 1929. And in the next section, you're going to see exactly what they are and why they work even when everything else fails. But before we go there, you need to understand one thing. If the old playbook turns you into the victim, then you need a new one built for inflation 2025, not 1995. Because resets don't give second chances. They give consequences. And your positioning today decides which one you receive. Here's the truth nobody likes to hear. Collapse doesn't kill everyone. It kills the people standing in the wrong places. And in every major crisis since 1929, only 3 positions, 3 deceptively simple positions, consistently kept ordinary people afloat when everything else sank. Tactical cash, distrust, the system gold, and long-term ownership of real businesses. Let's break that down the way Wall Street never will. Cash isn't safety, it's optionality. It's the ability to strike when everyone else is panicking, when assets are on fire sale, when markets are blind with fear. Cash is not where you hide. Cash is where you wait, briefly, so you can move faster than the crowd. Gold is not an investment. It's insurance against the one thing no currency has ever survived, the loss of trust. When governments choose inflation, gold holds its line. When currencies break, gold resets the scoreboard. History doesn't worship gold. History uses it as the measuring stick when everything else fails. And then there's equities, not speculative bets, not meme stocks, not short-term trading. I'm talking about broad ownership of the productive engine of the economy itself. When currencies inflate, revenues inflate. When prices rise, earnings rise. Businesses adapt. Paper money dissolves, but productive enterprise survives and eventually recovers. Cash for speed, gold for insurance, equities for the rebuild. Together, they form what I call the survival triangle, the only structure that protected people through the Great Depression, the 1970s inflation, the 2008 crisis, and every historical reset before that. And here's the part most people miss. Your allocation changes based on your stage of life. If you're 25 to 40, your biggest risk isn't volatility. It's missing the chance to buy assets cheap and ride the recovery. Your triangle leans heavier toward equities, with enough gold to guard your foundation. If you're 40 to 55, your goal is insulation and strike power. A balanced mix. More gold than your younger self, enough cash to act when fear peaks. Enough equity to participate in the rebound. If you're 55 plus, your mission is to survive the reset without watching decades of savings evaporate. You tilt toward gold and tactical cash, but you still keep a slice of equities because the rebuild always rewards owners, not observers. And outside of this triangle, you add real-world hedges, a bit of real estate, essential skills, a small side business, energy prep, even basic food storage. Not out of paranoia, but out of pattern recognition. Because the pattern has never been gentler than reality. Here's the part that should wake you up. Buy some gold and some stocks is not a strategy. It's a slogan. You need structure. You need a plan. You need a timeline. Because in a 3 to 7 year reset window, your margin for error is microscopic. And that window is open right now. What you do, or fail to do, in the next few years determines whether you walk into stage 6 as a panicked saver, or as someone who already moved into the only positions history has ever rewarded. Most people won't move. They'll freeze. They'll hope. They'll trust the same playbook that already failed them, but hope is not a hedge, and trust is not a strategy. You don't need to predict the reset. You just need to avoid being the person it erases, because collapse is not the end. It's a stress test, a brutal one, but also a selective one. People who prepare don't just survive, they position themselves to capture the biggest wealth transfer of their lifetime. And in the next video, I'm going to show you exactly how to rebuild your 401k and portfolio for inflation 2025, how to cut the dead weight, strengthen the survivors, and shift into the positions that don't need to get sacrificed when the math finally does what it always does. Make sure you're there. Because history doesn't wait, and neither will this reset.